Human behavior or something that you can almost predict that people get used to something and they're not going to give it up. So that's why we're seeing so much of the lag effect of all this money is being spent, but the consumer debt is going up. So credit card balances, mortgage balances, that debt is going up.
Then they didn't stop spending, did they?
That's the problem. It's the behavior. They don't want to stop, living the life they became accustomed to. These headwinds are there, and that's going to cause more stresses on the economy overall. There's a lot of opportunities. It just requires a shift in how you run your personal and your business investing model, whatever that might be. And a lot of people aren't making that shift right now because they don't see it, they don't have experience in it, they don't believe it. Hi, it's David here. Wanted to share with you a conversation that I had with a good longtime friend of mine in the real estate space. His name is Mr. Eddie Speed. That's right, Eddie Speed. Eddie and I both started in our respective real estate ventures about the same time, the same year, 1980. So yes, that definitely puts us in the category of being boomers, baby boomers. But we've been at this for over 4 decades. He took a little bit different approach than I did, and I kind of intertwined what I did into his model, which is primarily buying note receivables, seller financing, discounted notes, recurring income stream secured by real estate, which is something I do a lot of and have done a lot of over the decades. And it's really a place to go, I think, when the economy is really topping out and getting ready to go into a correction. I'm really moving away from equities more towards the debt side, debt as an asset, not a liability, as an asset, and preserve my margins and hedge my risk that way. Eddie's a master at it. He teaches training with what his firm is called Note School, and his larger enterprise is Colonial Funding Group. So anyway, we had a great conversation about an article that I recently got published in Newsmax. I'll let you listen to the back and forth between Eddie and myself and see what you think. Love to hear your comments. Thank you. I'm glad you introduced me as your longtime friend, not your old friend. So I'll take long over old any day of the week. So thank you for that.
David, if I remember correctly, you and I are just about exactly the same age.
We are almost exactly the same age, and I think we both got our initial start into the real estate markets as individual investors about the same year, about 1980. I think we both pegged 1980 as the kind of where we ventured forward. So yep, we kind of follow the path a little bit differently, but we intertwine in what we both know, equities and the debt finance market, but they all intertwine. And gosh, it's just looking back over the decades now, again, decades and the cycles that we've seen, and we're seeing another one right now, which we're going to talk about today a little bit. So I'll let you take it from there.
Guys, there's really just nothing else I could say other than honestly the passion and the hope that this guy brings to me in the market. I mean, he is so passionately cares. He so importantly cares about the market and you and us. And he is a guy that I rely on and listen to by profession, by license. Dr. David Phelps is a dentist. By expertise, he is an economist that I listen to. He is an expert in real estate investing. He is an expert in really globally. He's one of the most well-studied people I've ever been around. Dr. Phelps, I want to ask you a question. You had an article that was just published in Newsmax. We're going to have a link here in the show. And I was really impressed by that article, really the simplicity of it. And I want to talk about that article today. I want to ask you first, why did you write it?
Well, Eddie, I'm naturally inclined to question everything. I always have my whole life. Not that I don't respect my elders and respect authorities in different markets. I do. But I always, when I listen to people or read articles or whatever it might be, I'm always just trying to dissect away and say what do I believe is accurate and what maybe is not being presented fully as what we need to look at. So I wrote the article based on that premise that I believe that a lot of the media that we hear today, in fact, the Wall Street Journal, just over this weekend, I can't remember if it was the Saturday weekend edition or if it was Monday of this week, but even the Wall Street Journal came out and said, well, it looks like we're going to have a, quote, soft landing, the Fed's soft landing to the recession, which, we've been talking about for the last year and a half. Where's this thing going to go? Right. And a lot of the media is, picking up on that and saying, well, I've read also that the housing is bottomed out. Is what we're reading in the media. Housing bottomed out, and everything's good going forward. And soft recession, and really, it's just kind of like the sense of we're past all the hard stuff. The headwinds are over, and we're back to a quote new normal. So everybody just kind of like keep going. You go to the airports today, or go look at where people are traveling. Tourism and hospitality. People are just out there, and you just think, wow, the economy really looks like it's good to me. And that's the surface. You have to look underneath, and that's where I think there's some signals that people are not paying attention to.
Well, I think you're absolutely right. And I love your article. I think you did a terrific job of really laying out things that people need to look to. Like you're giving them good resources so that they can draw their own good decisions, right?
Yeah. I do like to correlate a lot of different data points and people who I tend to follow. We all have a bias, Eddie, right? We have a bias. I try really to listen to quote both sides of an argument, or in the economy. Try to listen to people who are saying it's all good, we're past the high points. So I listen to both to try to again get some balance to what I see. But yeah, I think the big thing for me is that we've had the fastest rise in interest rates, the federal funds rate, really in history, going back now, about 18 months, fastest rise in history. People say, oh, so what people will say to that, which again, I understand what they're saying. They'll say, well, wait, we're only up now to where, 30-year mortgage rates are, in the sevens right now, low sevens. Well, hey, if you look back over 40 years, the average was 7.78%, the average over 40 years. So we're just really kind of climbing back to the average. Okay, I understand that. That's a valid point. But the point is, we've been under this artificially low cost of capital for so long. Really, we've seen a decline over 40 years. So if you want to take a big span of time, 40 years from 1980, when we both first got started in the markets, we were dealing with rates that were much higher than today. But over 40 years, we've seen a decline. After the 2008 great financial crisis, we saw, again, rates stayed very low. And that allowed for a lot of speculation in all markets, financial markets, real estate markets, everything. A lot of speculation. When the cost of capital is so cheap, it leads to people doing things you otherwise wouldn't do. You take risk, right? Because the cost of capital is low, debt's low, you take risk. And that's pumped a lot of things up. Now we have the inflation factor that's come into play, and now the Federal Reserve has to fight that. So they increase the interest rates because that's the one big tool, the big hammer they have to try to reduce demand. And they've been trying to do so. They're making some headway with that, but I believe my feeling is, looking over the decades, and particularly going back to the 70s and 80s, is that once the inflation gets out of the bottle, so to speak, you can't just stuff it back in there and cork it off real quickly. It's out there, and so I think we're going to see a lot of back and forth. Where this year, I think the theme will be, and Jay Powell pretty much said it at the presser that they had just a few weeks ago, where they bumped the federal funds rate another 25 basis points. He basically said it that we're gonna maintain higher for longer. Maybe look at another 25 up in September. We'll wait and see. But a lot of people thought that they would reverse course quickly and start lowering rates. Now, I'm not saying rates are going to stay up here. I think they will come down at times, but I think what's going to happen, Eddie, is this inflation factor is so predominant now that we haven't seen in 40 years, that every time that they take the brakes off a little bit on the fight against inflation, maybe lower rates a little bit, maybe go back to some quantitative easing, which they really didn't start in a big way till 2008. And now that's become another factor that they've loaded, where the Federal Reserve Treasury will buy not only mortgage-backed securities, but we're buying a lot of corporate debt and things they've never done before. So all this has pumped up the economy, and people don't realize that there's a lag effect. So whenever you have this rise in interest rates, yes, we're seeing the quote overall PCE core inflation. Those rates are coming down, but they're still way higher than they were 2 years ago. People don't realize that the measurement of inflation is not a static number. It's a rate of increase. So
Yeah.
the rate of increase is going down. We're still way up here. I mean, look, every one of us knows, the cost of everything that we're dealing with today is gone up. It's way more than what the government will share with us, right? Just look at property taxes, look at insurance. I mean, we've all seen massive increase in that. I don't care where you live. That's gone up along with every other consumable that we have. So this fight against inflation has a long ways to go, and I just don't think we're going to see a return to some old normal. It's going to be more volatile, and that's what people have to I think take into mind. I'll stop there for a minute and let you dive back in.
Well, David, relative to inflation, I think a lot of people get confused by the numbers. I'm not sure I don't get confused, but when we hear 9% inflation versus 3%, let's talk about that.
Well, yeah, inflation is not a static number. Inflation is a measurement of the rate of increase, the rate of rise in inflation over a period of time, month to month, year to year. So when
do you mean like 103%?
Yeah. Yeah, exactly. So when we see these numbers, the inflation's coming down, and Powell or the current administration will be touting, well, it's coming down. Look, the effect of the cost of the rise is already there. So everybody's already paying up here, and just because the increase has gone from a curve looking like this, really sharp, it's a little bit more muted this way, but it's still going up historically way faster than we've seen in the last 40 years. So that's what people don't understand. This fight against inflation is not a one-time shot where you just raise interest rates and you're just going to tamp it back down and put it back in the genie bottle, right? Inflation, once it gets out, and the other factors that too, Eddie, just we have to keep this in mind, is that just since the debt ceiling crisis that we had in this country, 2 months ago, if people recall that there was, the big fight over, do we raise the debt limit, again, and there's always back and forth between the two sides. And of course, they always say yes at the end. There's a lot of positioning, right? And so they released the cap for another 2 years to get past the 2024 elections. How convenient, of course, right?
Yeah.
And so in the last 8 weeks, Eddie, we have added $1.8 trillion to the national deficit in 8 weeks, not a year, 8 weeks. We added 1.8 trillion. Now that plus go back, earlier this year to the, quote, Inflation Reduction Act. All right. If you look at that, as I wrote in the article, it's all pork. There's no inflation reduction anywhere in that. It's all spending more money. It's a lot of green energy stuff. I'm not against green energy. It's just all the things that the administration talks about fighting inflation, they're just stoking more into it. So all the spending of money that we don't have stokes inflation. So it's going to be an ebb and flow, I think, going forward. We're not going to ever get back to where we had 2% or under inflation, which we had for 40 years. That's over. And now that means the interest rates, I'm not going to say they're going to stay high, whatever high is relatively to 40 years, but they're going to be higher. And we have this lag effect that people also realize that the rate of the increase in the interest rates, it can take anywhere from 6 to 12 to 18 months to fully feel the effect. So the Federal Reserve is dealing with lagging indicators and trying to forecast what they see coming on board. The danger is they do too much and go too hard, and then it's like trying to steer the Titanic through the Panama Canal. You can't have fine controls. This is a big steering mechanism, and I think we're going to see this lag effect on the fight against inflation. It's going to cause a greater suppression in the economy in the next several quarters into 2024, where we're going to really see, I believe, a much harder recession than the media is counting on right now.
Well, and you talked about the federal debt, which is staggering. But another thing you talked about in the article is consumer debt.
Yep. So consumer debt, remember, we got the benefit of all of the Federal Reserve and monetary and fiscal policy by Congress, spitting out all the money during COVID. Okay. I'm not saying that they shouldn't have done something. They did, but like anything the government does, it just is what it is. It's very inefficient. And so they spewed out, trillions of dollars. The Federal Reserve balance sheet went up by like 5, 6, 7, 8 trillion dollars. That's all this money gets pumped out in the economy to save us from the COVID shutdowns. Well, the money, people were getting paid, multiples of what they were paid on the job to stay home, multiples. So again, disincentive to go back to work. People were flooded with money. They couldn't spend it for, a good year or even more. Travel was off. So people staying home. Now they got all this money and they got used to it. Human behavior is something that you can almost predict that people get used to something and they're not going to give it up. So that's why we're seeing so much the lag effect of all this money is being spent, but the consumer debt is going up. So credit card balances, mortgage balances, that debt is going up.
Well, when the government stopped giving people a check, then they didn't stop spending, did they?
That's the problem. It's the behavior. They don't want to stop, living the life they became accustomed to. It's again, it's kind of normal, but it's not good discipline. We can just say that. So these headwinds are there, and that's going to cause more stresses on the economy overall, I believe. And then we can start to relate that, I think, as you wish to here, into the area that we're most interested in with the people that we help, is in the real estate markets, right? So what's going to happen there? But I still think there's going to be a lot of headwinds coming. But again, we can turn that around, and you and I both know, because of living through these cycles going back 4 decades, there's a lot of opportunities. It just requires a shift in how you run your personal and your business investing model, whatever that might be. You have to shift, and a lot of people aren't making that shift right now because they don't see it, they don't have experience in it, they don't believe it.
Well, the one thing I certainly want to talk about, I do want to talk about real estate a little bit, but one thing I want to talk about, and kind of closing up the article, and that is, you talked about the canary in the mine. What is a signal that we should be paying really close attention to, and maybe what is a false signal?
So we look at the Federal Reserve looks at, economists look at, the unemployment rate, right? And so what we've seen over the last number of years is the unemployment numbers are very, very low. I mean, historically, very, very low. What people don't talk about is that this is very typical preceding a recession. So what happens is the rate stays low because as people are starting to feel the headwinds of higher costs, we just talked about higher costs, credit card debt going up. Oh, by the way, just to mention one more aspect. In October, the student loan pause on repayments, that picks back in. That's going to be another $10 billion a month. It's going to affect 30-some million payers. That's going to also have an effect. So we see these headwinds, but the unemployment factor is when people start feeling the strain in their own personal life, they start looking for second and third jobs many times, or spouses who have typically maybe not been in the employment factor will go find a part-time job. So that makes the numbers look good. This is usually what happens. So that's the canary in the coal mine, is watch that number and don't think that just means the economy's strong. It just means people are starting to feel the effects, and they're actually trying to pick up extra income where they can before things blow out. And then down the road, we start to see layoffs and recessions. And with most of the economy relying on 2-income families, husband and wife both working, when you start having layoffs, then people that are right now maybe just making it month to month, which is really the larger middle class, it really just makes it month to month. As long as things are rolling well and they're employed, they can make it. But inflation kicks up the cost. Now they're feeling the strain. They're having to work harder. You start having some layoffs, and we start to have a domino effect, in the overall economy. And we're seeing it with retail spending is down right now. It's going down. That starts to also show you how consumers are starting to shift their thinking, not spending as much. It's the tail end of all the money people got during COVID. That money is running out. I mean, it's shifting out right now. So I think that's bodes not well for the end of this year and into next year, because I don't think we're going to see with a split Congress. We're not going to see more entitlement or money coming out like we saw during COVID. I think that's over. And so now it's rubber meets the road now.
Well, I think the bottom line is, from what you're saying, is that people have more month than they have money.
Yes.
And they're trying to do everything they can to figure out how to fix that.
Correct.
One thing I wanted to ask you, David, before we talk about real estate is, can we tolerate deflation, and do we need deflation?
Deflation is typically not a good thing. The government certainly doesn't want it. So there's different kinds of inflation and deflation. So we're seeing a lot of inflation factors, certainly in assets. We've seen asset bubbles in the financial markets and real estate. We've seen some really big bubbles. I think that's where we're going to see the deflation, but not so much on the personal level. Personal level, we're going to continue to see inflation. So deflation in a lot of the asset bubbles, really exponential spiraling up, the parabola of the increases. There's got to be a correction. The steeper it goes up, anything goes up, the harder it falls down to what typically economists call it reversion to the mean. There's a mean line you can look at for any statistical model, and we've gone way above it. We've got to have a correction at some point, and I think that's what we're going to start to see. Different assets, different sectors, different all the way across the board. But yes, we're going to see some deflation, I believe, in the asset prices.
All right, let's talk about real estate. You and I have a heart for it. You and I played in this space a very long time, as we said, and you and I have done a lot of things together, and we have a lot of mutual friends. And David, let's be honest about it. We got some people out there drinking Kool-Aid, hoping that it's going to be a cure, or hoping that their method is going to cure or not really be affected. We're not wanting bad in any of it, but I think for all of the economy things that you've described in the article and that you've talked about so eloquently today, these things are now affecting real estate. And we probably had some things that were a false market.
Yeah, no doubt about it. Again, if we have to break, real estate into different sectors, of course.
Sure.
You have, multiple different sectors in commercial. So we'll just say commercials here, and then we have housing. And they're while they're related, they're different. And where it comes down to, Eddie, we both know, and this is, where you made your mark for decades, in the financing. When you look at financing, that's what drives everything. And we talked earlier on this conversation about the low cost of capital, which has been a big driver of assets going up. And then during COVID, we've seen continued speculation in both commercial and in housing. We saw people that were overbidding to get housing during COVID. Again, interest rates were low during that period of time. There's a lot of money pumped in. People were just were just bidding the prices up. Well, that's cooled off. The bidding wars cooled off because housing relies primarily on what we call agency paper. 30-year fixed mortgages. That helps stabilize our residential markets. They don't have that in Canada or other parts of the country, where like Canada, 5 years fixed is all you get, and then they have to refi. Well, that's a different dynamic. So housing overall doesn't see the amount of volatility. So I mean, some markets do. Some markets, again, the higher they went up, the more they come down. But generally, not going to see as much. Inventory is very, very low right now. Well, why? Because people have that locked in those lower interest rates. There's no incentive to move, and a lot of people don't have to move because the job market is much more flexible. The work from home, right? I know so many people, and you do too, that the jobs, even coming out of COVID, where people were forced to work from home, a lot of people have not had to go back, and that model will probably stay. So when people are not forced to sell, and then you got lower interest rates, why would you? Because if you have to get another loan to buy another house somewhere, well, your rate just doubled, and therefore your mortgage payment. So until you have to sell because of health problems or job problems or family problems, then that's why the inventory is low, and there's not much coming on the market. So even with higher interest rates, housing overall has not seen any market declines. Yeah, it's softer, but not market declines. We'll see where that goes. I'm not going to make a prediction there, but again, that's why I've always been a fan of residential. I believe it's the most stable market. But of course, we have our friends on the commercial side, and I'm not against commercial. I do some things in the commercial markets, but that's where the speculation also has driven asset prices, through the roof. We've seen that in all the equity markets that we have friends in. That's certainly office taking the biggest hit because of, again, COVID, work from home, remote work. Office will never come back to where it's at. That's going to take a big plunge. But then we can get into other sectors, industrial, multifamily, self-storage, on down the line. And again, going back to financing, because a lot of the operators have relied on the short-term bridge financing to buy their quote value add projects, which worked so well when the cost of capital was low and stable low. Then you could turn these projects no problem at all. You didn't have to even be a great operator. Let's just face it. You didn't have to be a great operator to quote make money in your syndications, whatever you were doing. But now the headwinds of the higher interest rates are forcing the values to come down, because as the rates go up, the NOI, net operating income, is decreased, which reduces the valuations. And now we have to refi, going from a 3 or 3.5 up to a 7, 8, 8.5%. Those numbers don't factor. So there's trillions of dollars that have to be refined this year, next year, 2025. It's a rolling process. And I think, again, we're at the tipping point right now where that's starting to roll over. That will cause problems, pretty heavy problems, I think, overall in the commercial markets. And that will, again, provide opportunities for those who are positioned to take those.
You and I have a mutual friend, Jim Ingersoll. He has an incredible Facebook page, 350,000 people on this Facebook page. I can't even fathom.
It's a whole city. That's Jim Ingersoll, mayor of the city.
He's a super, super, super sharp, good, ethical real estate investor. Yes. David and I have a lot of history with him. David particularly has done even a lot of teaching with him. And on his Facebook page the other day, I don't respond to much of this because it's just not my thing. I don't even always tell you happy birthday on Facebook, but I try to remember. By the way, happy belated birthday.
Oh, thanks.
But the other day, somebody said, in looking back over long careers, like, what is the one lesson that you've learned the most? And I typed in there that timing is way more important than perfection. That you can do something average in perfect timing, and it's way better than doing something perfect in bad timing. And so I think the point of this information you're doing, and we'll certainly make the article available in the link. And also I want to make sure that people just know how you have such incredibly good blogs and just good stuff. I know you've got a dentist audience that you serve well in your mastermind, but I love reading your stuff and hearing your stuff all the time, and we'll make sure that our audience has that. But I said in there, David, that the timing is so critical, and you can't have timing without knowing what's happening.
Right.
Otherwise, you don't know what the weather report is.
That's right.
And so I think your heart for this, and you're just constantly pushing stuff out there, and it may sound contrarian to some of you guys, but you know, since the biblical days, hearing a truth, and there's never been wrong with hearing a truth that is absolutely the way things are. And so I thank you for that. The industry thanks you for that.
I tend to take a contrarian approach. That's just number one. I don't usually follow the trends of what other people are saying. Not that I'm just out to be different. I think I just am different. But I just, I think going back to, many years ago when I was growing up, and gosh, I can't even think of it'll come to me, but great thinker, great influencer said, whenever in doubt, don't follow the majority. So I always kind of took that place and like look the other way. And so I think can be a lot to be said about that. We certainly looking at economic cycles over the years. We can go back even just to the most recent, financial recession in 2008 when Bernanke, was the one who was saying, "Oh, this subprime housing thing, it's basically no problem." I mean, all the pundits, and that's why I say when I see the pundits saying soft landing, the bottom's over, it's all back to the good old days, I'm just like, probably not so fast. Not being a critic, but as you said, the timing is everything, and balancing, one's portfolio. Speaking like more specifically about a portfolio, you and I both have a lot of respect for, both the equity and the debt markets, debt as an asset, seller financing, holding notes, right? Non-performing, performing. My overall stake is right now, I'm much more on owning debt as an asset today versus in the equity market. And again, that's part of my overall balancing. Not to say I don't have money in equities, but the money I have in equities, are performing. It's performing, fixed interest rates. It's going to be okay. Values can still come down as long as it's performing. I'm okay. But I've positioned a lot more over the last year or so, on the debt side, because I think that's a safer, it's higher ground. I've got more fungibility there, more flexibility to make moves when I see the equity markets may open back up again, which I don't predict will start to happen at least until next year. Who knows after that? I think there's a wave of opportunities coming there if one is patient. And who likes to be patient? No one's patient. I still see a lot of people who are running their same models that worked well in the last dozen years or last 6 years or even last couple years. They're still running the same models. And I think that's where the danger is not being able to pivot and understand how to make those pivots in one's given model or portfolio.
Well, but the banks are obviously scrambling, trying to clean their balance sheets up for a million reasons. Number one, they don't want to get absorbed by another bank,
Mm-mm.
which is apparently what is going to be an epidemic, is what all the reports say. But right now we're seeing a lot of inventory of notes because the banks are cleaning up their balance sheets.
Sure.
So they're either selling discounted loans or they're requiring their clients to sell discounted loans.
Yes.
So we're seeing a lot more loans than we've seen in a long time, which is going to what you said. Somebody asked me, like, was I making a play in commercial yet? And I said, oh my gosh, no, it's not. The knife's way up here. It's not even fallen yet. You're not to speak of it. I have a very smart couple that's in our note school family, and they are in the multifamily space. And she told me yesterday, she said, we have an apartment complex that we paid $11 million for. We're going to sell it for 16. Our investors are like, oh my God, let's go do it again. And they're trying to explain to their investors, you can't go do it again. And in fact, we're selling at the perfect time.
Right. Yeah, at least they're wise to go back. That's the hard thing, I think, for a lot of people, Eddie, is particularly if they've been good at raising capital and putting them into projects that heretofore have done well. It's not only do you have a band of people who want to stay on that same train, but boy, to go back and deliver kind of like the bad news of like, well, this train's run its course. It's hard when a lot of money's coming your way to like push back. And I think the most disciplined, most experienced investors or operators are the ones that will do that. And I have great respect for them because it's hard to not take money that's being almost just handed to you freely to go do what you want to with it when you know the market shifted and you know you're not going to get the same results. In fact, probably dismal results using that same model.
I can tell you, David, that we probably bid on 500 to 800 non-performing loans last year that we thought people were overpaying for. And we intentionally bid knowing we weren't probably going to win the bid. And when it affects your overhead and your staff and their commissions and all that stuff, it really hurts.
Yes, it does.
But age sometimes does help.
We didn't get that gray hair for nothing, did we?
Got some old scars, right?
That's right.
David, you're awesome. I really, really appreciate it. I want to make sure that we get your Freedom Founders link in there as well. Let me just encourage you guys. David has an incredible email distribution where he can just send you blogs and stuff, just smart stuff, just really good life lessons, really good things about the market. And I'm a fan, and I believe that if you guys would add this, it would help open your vision. David and I have spent many, 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 many hours together doing lots of things related to this business. It's a man that I respect. Thank you, Dr. Phelps.
Eddie, it's always a pleasure. Thank you. If you enjoyed watching or learning from this video, please leave a like and subscribe to my channel for more content. If you have a question about any of my content or this specific video, just please leave a comment down below. And as always, stay focused on your freedom. I'll see you next time.